Hi, this is Ira Gold. Home sellers, your house is on the market. You just got a bunch of offers and you are so excited because a couple of those offers are higher, way higher than the others. You want to take them right now. But don't, wait, hold on a second. Don't be blinded by price. Yes, price is important, and yes, you want the most amount of money for your home. Trust me, your agent does as well. But there are other factors in an offer that supplement price and can help make or break your escrow. So to that end, what in general makes a really good, well-rounded offer? Here we go. Length of escrow. Do you want a longer escrow? Do you want a shorter escrow? Escrows on average are about 30 days, give or take. There's no real set standard here, but a financed offer is about 30 days because that's usually as quick as a lender is able to fund a loan. But some escrows can be shorter, some escrows can be longer. That really depends on you. This next one is a big one and often overlooked. It's the buyer's lender. To avoid any potential loan hiccups or complications once you're in escrow, you want to make sure that the buyer has a reputable lender who has thoroughly vetted the buyer's financials and loan application. You also want to know if this lender has a reputation for delays or for surprises or hiccups or cancellations once in escrow. You want to know this before you accept that offer, so that way you can make an informed decision. The next thing to look for is the buyer's financials. We've all seen that movie with Tom Cruise, the one that says, "Show me the money," right? Well, that couldn't be more relevant than this point here. The buyer with their offer is supposed to submit something called a proof of funds. And it's usually in the form of a bank statement, but it doesn't have to be. And this just shows that they have the money that they need to close escrow. What does that mean? It shows that they have the funds for their loan's down payment and for closing costs at the end of escrow. You may want to make sure that all these funds are in place prior to accepting their offer. You also want to look for the lengths of the contingency periods. As a seller, you want the buyer to buy the home. Right, that's obvious. And during the escrow process, buyers have a certain period of time in which they can perform certain contractual actions and move forward or cancel based on those actions. Those are called contingency periods. These include things like inspections or appraisal or final loan approval. And if a buyer is going to cancel, you want them to cancel sooner than later so you can put your property back on the market as soon as possible. So you want to make sure that the buyer's contingency periods are as tight as possible within reason. You also want to look at the allocation of costs on the offer. This lays out what each party pays for during the course of escrow. Now, everything on a contract is negotiable, but this being said, each region generally has their own roadmap of what a buyer usually pays for during escrow and what a seller usually pays for during the course of escrow. If the buyer wants you to pay for, let's just say, their own closing costs, that could eat into that nice high number on the offer and eat into your profits on the sale. So you want to consider that. At the very least, the allocation of costs should meet the regional standard. At the very best, maybe the buyer will want to pay some of your costs. A buyer who nickel and dimes you at the start before their offer is even accepted is generally going to be very difficult to deal with once in escrow. So make sure you consider that along with the price. So to summarize, all these different points that I've mentioned are things to think about when you're considering which offer to accept. Yes, price is important and very tempting, but if the price is amazing, but the rest of the offer is not, you could be in for a bumpy escrow or a cancellation, and that's the last thing you want. So take these points, I hope they're useful, and go get them.